bring in here Paul Bloxham, Chief Economist at HSBC in Australia and a former Reserve Bank economist as well. Paul, I mean, that's the big guessing game. The markets kind of looked at this and went, well, it's one and done. There's not another one down the line. But there's still a bias towards raising interest rates even further.
Yeah, so I think a part of this story is how much you think about the local story, the Australian story, and how much you think about the global story going on in the background as well. So on the local story, it's pretty easy to make the case that actually inflation's still sticky, it's still elevated. They may have to do more because the economy's got momentum. We've got quite a lot of momentum right now because we've had this really large surge in population growth as well. And so I think the domestic story might just about get you there. But you can't do that alone. You just can't. You've got to think about the story in the context of the global picture. And the global picture is one where the Fed looks as though they're probably done in terms of lifting interest rates. The ECB is pretty much done. The Bank of England looks as though they're done. That's because Europe is stalled. Its economy stalled for 4 quarters now. The US economy has been quite strong, but I think there's some signs that it's starting to slow. And of course, they've had that really substantial tightening in financial conditions because long-end interest rates have gone up very, very quickly over the past couple of months. So that's going to slow things. China is stabilised, but, still on the weak side. So I think if you look at the global picture, you say to yourself, there isn't much tightening coming through globally anymore. We'd be alone if we're doing a lot more from here. And so I think on balance, I say, even though there's domestic momentum in inflation and it's sticky, I don't think the RBA is actually going to end up delivering another hike because I don't think the global story is going to be sufficient to get them there.
But what it also does is by raising the cash rate to 4.35%, it gives you a chance to get the real inflation rate back down to neutral more quickly. If it does drop down towards that level, it means there's less pressure on the central bank to do more.
Well, certainly the tightening they've delivered today, the additional bit of tightening, I mean, it was almost as though, they really needed to give deliver another one because they got this upside surprise to inflation. They've got more momentum than they thought. They've got to revise up all their forecasts. And it wasn't going to be plausible for them to say, look, we can revise all these short-term forecasts up, but we're still going to get back down to where we need to be over, just get down faster. And so I think they needed to move. And I think that's going to, as you say, deliver a tightening of financial conditions that slows things down a bit, gets them on that track. But we know we are on the track. Inflation has peaked. It's running a little quicker.
The narrow path, they call it, right?
We're on the track for inflation coming down. Whether we're on the narrow path, that's the question about whether we tip into a recession, an outright recession or not. I guess my leaning in that debate at the moment is, well, we've got very strong population growth. Yeah. It is really hard to get an economy to have an outright contraction in GDP when you've got a lot more people coming through. Now, you can have a debate about that too, because per capita GDP, well, it's already falling. It's already falling. So if you want to define it certain ways, you could say, look, we're already in a downturn. But in an aggregate sense, in a traditional sense of will GDP have 2 consecutive quarters of printing negative, it doesn't look that likely because you've got such strong population growth.
OK, so the Reserve Bank, it seems, was trying to get away with a 4.1% peak cash rate. And things have changed. And that's meant they've had to go again. Now, the point is that the history of central banks is that they go with one rate rise too many. The one last rate rise is that plunges your economy into recession. The question is whether this is the one rate rise or whether it's the next one that comes out of the track.
We'll know in retrospect, but that's how it always works. But I think what we can say is the cash rate is now well above neutral. It is slowing the economy down. That's evident. I mean, it's having an impact on the retail sector. It's having retail spending. It's having an impact on the consumer. We're seeing the effects of it. So we know we're above neutral. And because the RBA knows they're above neutral and growth is already below trend and they've lifted rates a long way, I think they'll go much, much more slowly now.
OK, so see here, just have a look at this. So these are the interest rates from the central banks around the world versus their inflation rates on the right-hand side. You can see Australia is still well below where the inflation rate is. But the expectation would be that inflation rate starts to drop pretty quickly as Australia's economy starts to cool.
Well, that's right. And the RBA is forecasting, as they said today, that inflation rate will be 3.5% by the end of next year. And previously they were expecting it would be 3.3. So that's your slight nudge up in the forecasts. But at 3.5, it would still be, well below the 4.35% cash rate that we've got at the moment. And so one way to do it is to look at where you are right now on inflation and where you are on the cash rate. Another is to look at what your projections are, what your forecasts are, and where the cash rate is relative to those forecasts.
At the margin, there are going to be businesses, there are going to be households now that will be tipped over the edge by this rate rise. That's inevitable, isn't it?
Yeah, well, it happens in every cycle that you have some households and businesses, as you say, that really are stretched, and that's what happens. I mean, that's a part of the way the monetary transmission mechanism works. At the moment, moment, if you look at the statistics, there aren't many households that are tipping over or defaulting on mortgages. Those loan arrears are still very low. And one of the things that's helping, or a couple of things that's helping that, one, the labour market's still strong. There's still employment. The unemployment rate's still quite low. And the other one is that house prices are rising. So if people do really struggle, there's an option here to sell, which is not a great story, but it does actually it does support the idea of a soft landing. And as far as the businesses are concerned, look, corporate insolvencies have gone up quite sharply, but that's because they were so extraordinarily low through the pandemic. They've gone back to a bit above normal. They were well below normal because we put all these sort of restrictions on corporate insolvencies through the pandemic. So that's a part of it. And there's some unique things going on in the construction industry, as we know, with the high inflation and the high materials costs delivering a very large shakeout in that industry.
And just quickly, this looks to be a pretty good start for Michelle Bullock as Governor of the Reserve Bank. She's asserted her independence. Clearly the government didn't want this to happen. And on top of that, also has made a very strong statement about monetary policy and inflation fighting.
Look, I would add one more thing to that, because I think that's all very true as well. But I think also that she's made it clear this is a board decision. It's not the governor's decision, because when we led up into this meeting, we didn't see she wasn't able to turn up at the Senate estimates and give a clear view. Look, we think we'll do this or think we'll do that. And the reason is because it's a board decision. So they're taking options to the board and they're operating in a different way, which is a precursor to the implications of the review, right? The review of the RBA stipulates that they have to put a new monetary policy committee together, and it will be a voting committee, and it's the committee that decides. Well, they've already done a lot of that, and that shift is pretty clear, I think, in the lead up to this decision that we saw today.
So, Paul Bloxham, always good to get you in on these days, and many thanks for your time today.
Thank you.